implied volatility, OPEX flows, Vanna. It's pretty confusing, isn't it? Does it make you feel bored or confused? Well, that's the intention. Wall Street likes to use complicated terms to make you believe only they can handle it. Or even better, just to leave them alone. So here's Margot Robbie in a bubble bath to explain.
Basically, the CBOE's zero DTE options are amazingly profitable for the market makers. They make billions and billions on the spreads they receive for running their quotes. But then they have to deal with the risk of holding them. After all, there are so many option sellers and only so many Muppets with deep enough pockets to buy them, right? So dealers started hedging these books with faster and tighter systems. Thank you, Banjo. That way they can keep that profit machine churning, right? By the way, these hedging programs are all real-time. So whenever you hear real-time, think edge. Our friend VolSignals discovered these index markets, which were supposedly hard to trade, were actually quite easy to predict. So now he's giving you back your edge, which means to help you win. Got it? Okay. Now fuck off.
Morning, Matt.
Morning.
There we go. I got a big man energy. Nice. All right. Thank you guys for sitting through that intro. I think I'll never get rid of that one.
I like that one.
Let's see. Yeah. Have you seen that one? Have you been on this one?
Yeah,
Is it new for you?
I've seen it maybe once before.
Yeah. Okay, cool. So what should we talk about today? Today, we're going to talk a little bit about the platform. Obviously, it's a kind of a good day to show this stuff too, because we have NFP. And so we used to do mentorship calls every time we had these. I think the guys in our mentorship know very well how this works now, but it doesn't always work. But sometimes these give you a good signal into the first move. You know, the whole point with what we do at VS3D, we take this idea that a lot of the market is systematic and structural. You know, Matt worked at big banks. I probably faced him on a lot of flow before we connected and traded with each other. But and myself at Belvedere Trading, a big index market maker in Chicago, a lot of what we learned over our careers is really how much influence we had in moving markets, for lack of a better term. And it's not so much that there's any manipulation or anything, just that there's so many options traded and there's such big positioning out there, and the underlying is only so much liquidity. Option hedging can move markets, can move them to greater extent recently, when you see how much of the liquidity in the underlying is moving to markets. So interesting concept. And the whole point is, this is not TA. This is not making inference out of the past. What we do with VS3D is we take the entire market maker position and we then model it as if it were our own. And Matt, you want to explain how that's done really quickly, or what makes our approach unique while I pull up the platform? Cool.
Yeah, sure. Our approach, what we do is we ingest all the position data from the CBOE, okay, and we build the entire position. So we don't base anything off inference or naive gex or anything like that. We build the entire position from the CBOE data, and we have some, and we also have some. We have some trades that we have some trades that others don't in our platform. That we know how to model based on.
So also not inference, right? To be very clear, it's based on our experience market making and managing these things. Matt at a bank handled a lot of order flow of consequence. Like I think Matt, I don't know if we can say, but he worked with the JP Morgan caller at one point at the shop you're at. And there's other flows too that are just like that, very dominant structurally, but that don't make it to the listed open interest the same way other flows do. And so to get a proper readout, right? If you compare our curves to curves of competitors, the gamma profiles that we produce, customers tell us all the time, oh, you look different to X, Y, or Z. Why is that? Who's different? Well, I can tell you that our experience informs how we choose to build this. We look different because we capture a more comprehensive set of positions. That becomes very important to get the right Greeks. If you ever come across things from Zero Hedge, or you see, for example, a Goldman note or a Bank of America note or UBS note, you'll notice the research that I produce and put on X sometimes, the gamma curves look very similar to what you get at the banks. Obviously, they have the same, they have access and the insight, and we try to give that to you guys too, without needing $250,000 or whatever, I don't even know what the hurdle is to get prime brokerage research. But no inference, no guesswork, It's not naive. This is multiple steps from naive. When we say inference, I'm not sure most of you know what we're talking about. Inference, there's another way of doing this. You'll get a lot of guys out there in the space that claim to have good positions. What they do is they take every trade that comes across the feed. And if the trade happens close to the bid price in a two-sided market, they'll assign that as a market maker buy with the idea that you have to buy for edge. If your midpoint is your theoretical, you're going to only buy an option if you're incentivized to do so. That is logically pure, but functionally just not how it works. No. Great if it did, but it doesn't. Oftentimes, our trading choices are not so simple. A lot of times we'll buy things near the ask, or remember, also a two-sided market in the SPX is not just my market or Matt's market or whatever. There's maybe 30 entities alongside a customer bid or a limit. You have no idea. One market might be 2 at 4, another might be 3 half 5. Who's the real market to lean on? You don't get good information out of inference. We put the pieces together correctly, like what Matt said. We get the data from the source, and so there is no thing. There's another super important thing that I think is even as important as getting the direction right, the position right. I think I'm gonna kind of lead you to this one, Matt, but like, who holds what, right?
Yes.
Explain that really quick.
Yeah, sure. So we basically assume that, I'm not assume, we well, sort of assume, but it's based on, it's not a naive assumption. We, from our experience, we know that most of the risk and most of the hedging that we're trying to model here and that shows in our platform is based on what market makers need to do. Okay, most of the risk in the S&P ends up in the hands of market makers, and they're the ones that are doing the most active hedging. I know this because I worked mostly at banks, and I did spend,
how did banks report? Were they were firms, right?
What's that?
And so in your capacity to seat at a bank, you would clear as a firm, right?
Correct. Yeah. Correct. And we hedged not as actively. We definitely hedged, obviously, but we didn't hedge gamma as systematically as they do at a market maker.
Look, we have systems that are pretty rigid. We have a lot of systems that are plugged into exchanges, meant to not only hedge a trade, but also then fire off hedges against our book. A lot of that logic is baked in.
Just hedge. The market makers hedge much more actively and systematically than banks. Obviously, there's every rule is not 100%, but for the vast majority, that is the way it works. So that's why we look at the positions in terms of what market makers hold. Now, if you choose to want to look at other entities, you're more than welcome to.
Yeah, you can break down by segment, but obviously the whole point is that what we're trying to articulate is that there's a position, like if you look at the open interest, for example, you're going to see a position that's massive. And that massive position actually is misleading in terms of what all the contracts are doing. Because for one, if I trade against Matt, Matt was bullish. He was probably more correct than me in some time frame. Got a little bit of a dip, right? But if I trade against Matt in personal capacity as a customer and we cross contracts, that's going to show up in open interest. But guess what? Nobody's hedging it. Matt's not hedging it. I'm not hedging it. Although I should have hedged, this time. But the point is, it doesn't actually go into a position that is hedged. So if you're doing something where you're trying to tease out an influence on the market by way of the hedging process, but you're using open interest, you're getting so much noise that is completely distorting your signal to a point where, yes, there might be correlation sometimes, because to have a big position, you must have big open interest, and big imbalances will live where big open interest is, but you don't have anything precise. So you might as well go flip coins and tell yourself that you're doing something that's logical or whatever, but you're starting from a premise that's just not correct. And so to get it really actionable, in our opinion, requires you to not only get the direction and position on every single contract right, but for the subset of participants that are hedging, which again, we think is market makers. When you do that, you see some really incredible things. This week was explosive. And if you look at how explosive it is, someone asked the question, are market makers in long gamma? Well, look at the profile right here. On the right-hand side, what you see is the overall gamma position for all market makers. Now, this is a combination of market makers. It's not one, and they don't all have the same position. It's what I would consider neutral to short. This is basically flat, an exposure of 26 gamma. this is very, very low percentile exposure right now. The moves that we had earlier this week, there was a moment when I think we were actually in really, really positive gamma territory. I think maybe the naive Gex models and all the open, the inference models had it structured a certain way across a big range. Well, when you look at what's actually happening and you understand the actual market maker position, and again, the way we build it, but also the Greeks that we look at, we had spot up, vol up conditions very clear in our platform, right? And what do we see after that? I did a video last night that highlighted the correlation between vol and spot. Matt likes to talk about fixed strike vol all the time. You get information out of this position that goes way beyond just our market makers and long gamma. I think I did make a video out of what happened yesterday. If you look at my YouTube, to the question on YouTube, what happened on Monday? Monday is not so much predictable, but it's one of those moments when you have a platform like this that shows you not just gamma and charm in the 0 day, because a lot of platforms just cover 0 day. You want to use something called Vanna. This is kind of a complicated one. It goes a little bit beyond the scope of most of our videos. But Matt, do you want to give a quick, high-level explanation of what Vanna is?
Yeah, sure. Vanna is how your position changes. It's how your vol. Technically, it's how your how much Vega, your D Vega D spot, D Vega D vol. Excuse me. It's how your
D Vega D spot. No, you just said.
I'm sorry. I'm sorry. I said it wrong. D Vega D spot. I apologize. I need a little more coffee. No, I'm not too tired. I just need a little more.
I said fired, not tired, but I'm joking.
Fired.
D Vega D spot, right? So if most of the time,
it's how your Vega changes with respect to spot. Yeah.
Yeah, most of the time. And the whole reason for skew in the SPX, for example, is because if you think about the world of equity holders, you're going to buy equities, you're going to buy puts against them and then sell calls. And so your position then becomes pretty much structurally similar all the time. Like if you think of the JP Morgan put spread collar, for example, there's just one entity of many. In fact, I think I read a report just yesterday that was produced a year ago, and probably that number has grown by now, that if the JP Morgan collar is maybe 18 billion of NAV in this one type of structure, there might be 75 billion of assets in positions like that. Well, it's a risk reversal. It's an entity that buys puts against equities and sells calls. What that does for us as market makers, it gives us a position that creates the vol surface you guys trade, right? The vol is cheaper on the way up for that reason, because we own more of it. It's more expensive on the way down because we're short it. That's not always the case. That is captured by Vanna. Literally what it's saying is, as the market goes up, we're getting shorter and shorter Vega, because as you go closer to a straddle, for example, the most Vega the option can have is when it's at the money. So if you have a position that's long or short calls, upside calls out of the money, your Vega position as a static Greek will change as you go towards it or away from it. Well, most of the time, very much aligned with the structure, is your position gets longer Vega as you go up, because you're going towards those calls. But sometimes you go to those calls, maybe through those calls, and above it, because a lot of what people do is sell call spreads, not calls, or they buy call wing to hedge. All of a sudden, you're inverted. It's like you have a position that's totally different. And those conditions can be explosive sometimes. What was fascinating about Monday was the 0 day straddle never priced above $30. But we moved a ton. Maybe
it was crazy.
Was that Monday or Tuesday? They all blend together.
It was Tuesday. It was Tuesday,
right? Yeah.
Yeah. Monday we got the first vol up, spot up, and Tuesday.
Yeah.
What's important is in Vanna is it's how your vol changes with respect to spot, as we said. But then you can translate that into how your delta changes in respect to vol, and that's really what we care about.
Yeah, that's a big one. It produces feedback loops that are like gamma.
That's the important thing, because that creates the hedging. That creates hedging for the market makers.
Exactly.
That's what's so important.
Is Vama the same as Volga?
Vama?
This question here, is there there's some good questions in the YouTube channel here. Are there any academic papers or resources to learn more about this? I'm sure there are. But what I would also say is a lot of the academic papers are grounded in methodology that's maybe not as robust as it could be. But I'm sure there are.
What was the other question? Is Vama?
Vama. I think Vama is Volga. So if I say Volga, I think it's the same as Vama. Volatility gamma.
That is your, that's your D Vega D Vol.
It's a great question. Are they important to fixed income account? In some sense, yes, definitely. I look at them a lot, but they're also not ones that are obviously translatable into day trading. And so they're almost like, if you're a vol trader, which maybe some of you are, they can be important. It's important to know in the SPX of a position that's really short wings, for example, right? Because then you should expect maybe vol should move a lot more. The vol of vol might be higher. But it doesn't translate into the same things we're looking for on a day-to-day basis. For example, yesterday we had a really good session in VS3 onboarding, talking about trading, walking through how basically my entire approach to trading this market now, at a level that's better than anything I've done in the past, is using what we have right here to trade. And it's just 0-day position, market maker gamma, market maker charm. Vanna is kind of even something that I would say gives me a flag on whether there's what I would call shadow gamma, like we can move more than the gamma implies, as you guys saw, right? When the gamma was positive the other day, but we still moved $150, that is a shadow gamma concept. You need to be aware of when those conditions are present, and our platform helps you see that, obviously. But it's also not immediately obvious that those conditions don't give you a day trading range like the 0-day platform does. And Veda must be how Vega changes over time, is my guess.
Veda.
Yeah, we're going down the rabbit holes here.
Whoa, we're getting into it.
And I would say they're important, but again, for a vol trading lens, which we're also working a lot on the back end to structure a lens here that is more for vol traders and long-term positions. But today we have NFP coming up. Does anybody have any clue what the expectations are for NFP? Matt, do you know?
I have to look it up.
I say it kind of like in jest, but I'm serious. When I don't pay attention to macro, I mean it. I usually ask the Discord to tell me what's going on. Only because I find that I have all the best opinions that don't matter at all in terms of making money. But the position gives us something even better, right? What I would encourage you guys to think of here is actually really robust if you think about it. You have the market maker position, which gives you a hedging influence that's predictable and tradable. It's like a prescription, and it really is. Because if you have this position, you have kind of an onus in your business to be delta neutral. And if you don't hedge the position, you're kind of flippant on risk, and that's not really tolerated very well unless you're very well capitalized. So it's very aligned with what you see here. On the other side of this is a customer book. And so if you think about what you're looking at here, you're getting a prescriptive model for required flows. That gives you a weighted coin. If you can get a little bit of a bias and know that, well, there's implied selling here, charm is suggesting that the market maker profile is going to get longer delta, and we should expect that they're going to be hedging that by selling futures. That is a little bit of a bias to know that there's an entity here that will be selling as time passes. There's another weighted coin concept here with gamma, where you can understand how the market is expected to behave in certain areas. More stable in some, less stable in others. It's conditional. You need something else to move the market to get anything out of the liquidity condition, but it's another bit of an edge. And so you have this like bias in your favor this time, understanding something more about how the market should behave, because again, this is not TA and guessing that somebody should do something because in the past it has happened. It's actually predictive. It's saying there is a position that I can say is verifiably true and held by hedgers, and I know how hedgers work. They're going to be doing something, and that gives you a bias in which direction the flows might go. So this morning it's interesting because we get a bias based on what market makers might have to do at a very illiquid time in the market. When the data comes out, liquidity drops and disappears for at least a moment there before it resurfaces. And whatever market makers might have to do may, not always the case, may be dominant to that period too. And so, for example, if we go into this and there's a charm down, what I like to remember too is like we have information that is very precise in a way. It can't be so precise, don't get caught up in this need for precision, but it's knowable. It's true. It doesn't determine the outcome necessarily every time, but even when it doesn't determine the outcome, meaning like if the bias is to go lower, that doesn't mean that the reaction from the market, if we do go lower, was a bad number, right? There's times when like the first move is the wrong move, or there's all these things out there that kind of try to explain this. But the reality is sometimes there's just an automatic mechanical impulse out of the position, and that can deceive people or can be read a certain way as sentiment when it's not, when it's just a program that's based on the position. So we'll see what happens today. Customers are hedging at 77.30, hedging at 78.10, way up there, obviously. If you look here, and generally speaking, there's more negative gamma to the upside again, several days in a row now, the same concept. So customers are still defending their position with call options. They're maybe not as allocated as they want to be. They're exposed to upside movement. They're buying call options, which is putting negative gamma on the profile. Now, before we jump, I'm going to say we're going to have a morning meeting in the Discord, which you guys are invited to join. I'll put the link in the chat here. When you think about the customer's position, think about it from start to finish as being hedged by us. So Matt, if somebody buys 100 lot of SPX 20 delta calls from you for this number, what's your hedges on your side?
Someone buys, so I sell the calls. Well, I need to buy 40. I need to buy 40 minis.
Yep, exactly. So we hedge the ES. So if you're trading futures, like just know that this is where the impact lands, is futures. And so from there, you think about, well, that creates negative gamma. A lot of people make the mistake of looking at a position bar and think, oh, there's negative gamma up here, we're going to go up. Well, that's a position. That position right now creates negative gamma, and that's a hypothetical. On the other side of that position's hedge, in terms of gamma, though, is the passage of time, dropping of vol. So if the number comes out, Matt, and you didn't do anything, we didn't get a spike up, your vol is going to drop on the contract. Do you think your first impulse
I need to hold less long minis against that, so I would sell those minis.
You're ahead of me. You're too fast.
I would sell a portion. I would sell a portion of those minis back out. And for those who are wondering, the expectations 80K jobs in 4 minutes.
Yeah, thank you to Optionfinity putting that in there too. Appreciate it, Nick. Yeah, we'll see what happens. It's interesting. A lot of times the customer's sentiment is already there, and then the impulse is also something you can kind of predict. So it gives you this dual lens way to look at the market. It's almost like you have an insight. I know I shouldn't say this on, like, to be clear, we have nothing that is inside information, to be absolutely clear. But it feels like it sometimes when you're looking at these positions, because you know that they create flows. It's about as good as you can get, as close as you can get to something that's really, really effective. All right, let's hop over and do the morning meeting. So for you guys who are going to join us in the Discord, what you're going to see is our morning meeting for VS Pro. For VS3D, you can get the data platform yourself. I encourage you guys to do so, actually, because Matt and I do onboarding every single day. It's the best way to do it, to have real context. Like yesterday in the trading segment, I got to walk through how I trade this and really see my trade tested at the lower boundary while I'm doing the call and stressing about it. But articulate my process, and it actually worked on the call. It's, again, no financial advice. It's not meant to be something that you're going to take as a prescription and just trade it. But the onboarding really helps because we do it in real market context all the time. We do it every day, 15 to 20 minutes with a Q&A at the end of the week. I encourage you guys to do that. The way to get that is just go to this website here. I'm posting to the YouTube commentary. And then VS3D is all about context. So we're going to switch over and hop over to the Zoom. The meeting stage is free in the Discord right now, so it's open. You can access it. You'll see what we do every day. We have about a 30-minute call to talk about the markets condition. I do my walkthrough of the profile. And then Matt talks about vol, and Nick has been nailing these single name calls lately.
Yeah, he's been on fire.
I want to switch to single names after like all his wins lately, but hopefully we see you guys there. So we're gonna hop now before the number. Godspeed.
Godspeed.
See.